Developing accounting standards that result in investor-friendly financial information is the core to our mission. We want financial statements to produce relevant, transparent, and comparable information without putting an undue cost burden on preparers.
To understand investors, it's important to understand who they are. Institutional investors are institutions that pool resources in order to buy securities or to lend credit or to buy real estate or other investment assets. Buy-side investors are those who take actual positions in investments. So they're pooling the resources and making actual purchases or lending credit. Sell-side firms provide research and often typically have a price target or a recommendation about a specific investment, but they aren't actually taking positions in these specific investments. Retail investors are investing for their own personal accounts. They typically invest in much smaller sizes and volumes than institutional investors. I would say the three overarching things that investors want from their financial statements are comparability, transparency, and what some would call representational faithfulness.
And there's two levels of comparability. There's kind of the businesses, and comparability, but I think the greater emphasis is actually on transactions. Do two companies that have exactly the same transaction, do they end up with the same results and the same disclosures? I think that's the more important comparability. It's not to make two companies comparable, but to make same transactions comparable between two different companies.
Transparency is essential for an investor to understand what's really going on at a company. Companies really should not be able to use accounting standards to structure transactions to get a particular accounting result. Representational faithfulness means, are the financial statements really reflecting the underlying economics?
Investors want financials that represent the underlying economics of a business. Ultimately, the investor is trying to understand the business itself and what the future earnings potential is within that company. If you have financial statements that match what's happening inside the business, it's much easier for the investor to do their job.
The investor clearly is our number one customer, but in providing information to the customer, we need to make sure that we balance the benefits that they're receiving with the cost that it takes to provide that information.
When we think about the benefits of a standard, we think about the information it imparts to investors and other financial statement users. Specifically, is the information produced by that standard relevant and important to the financial statement user? Does the information it gives to the investor justify the cost of providing that information?
If you asked an investor, do they do outreach, they would look at you with a blank stare. But in fact, that's what they do every day. They meet with companies, they get informed views, not only from the financial statements, but actually talking to people and understanding what are they doing, what are they seeing on the rise, and how do they control risk. The questions go on and on. In many respects, that's what our outreach program does here. We spend a lot of time talking not only with investors, but with preparers and auditors, getting their perspectives on a particular issue. And as I like to think about it, quite often there can be a misalignment between accounting and the economic realities. Outreach helps us understand what are the economics of particular transactions and how can we better reflect that.
And if the information is not all that important to users, but the cost of providing it is very high, we won't require it. On the flip side, if an investor needs information that isn't provided on the financial statements, then it's the investor that bears the cost of getting at that information.
To be successful, it is essential that board members understand whether the current financial statements are meeting investors' needs. And after implementation of a new standard, an analysis as to whether or not that standard actually made a difference to investors' analysis. But we know that all investors do not speak with the same voice, and that's why it's crucially important that investors get involved in our process.